Today in our review for the SIE exam, we are covering the essential topic of order types. Understanding these is not just about memorization. It is about knowing what tool to use for a specific market situation, which is exactly how the exam will test you. Let's begin with the most straightforward type, the market order. A market order is an instruction to buy or sell a security immediately at the best currently available price. The key takeaway here is that you are prioritizing speed of execution over a specific price. An investor who wants to get into or out of a stock without delay will use a market order. For example, if a company releases surprisingly good earnings and an investor wants to buy shares before the price rises further, they would place a market order. They are guaranteed to get the shares, but the price they pay is not guaranteed. It could be slightly higher or lower than the last quoted price by the time the order is filled. The exam might test this by presenting a scenario where speed is the clear priority. Next is the limit order, which is essentially the opposite of a market order. Here, you prioritize price over speed. A limit order is an instruction to buy or sell a security at a specific price or better. A buy limit order can only be executed at the limit price or lower, and a sell limit order can only be executed at the limit price or higher. Imagine a stock is trading at $51, but you only believe it's a good buy at $50. You would place a buy limit order at $50. Your order will only get filled if the market price drops to $50 or less. If it never reaches that price, your order will not execute. This is the trade-off. You get your price, but you risk missing the trade entirely. The exam will test your understanding of this trade-off between price certainty and execution certainty. Now let's discuss stop orders, which are primarily used for risk management. A sell stop order, often called a stop loss, is placed below the current market price to protect a profit or prevent a further loss in a long position. Once the stock's price trades at or through the stop price, the order is triggered or elected and becomes a market order to sell. For instance, if you own a stock at $60 and want to limit your potential loss, you might place a sell stop order at $55. If the stop price falls to $55, your order becomes a market order and you will sell at the next available price. A common exam trap involves a fast-moving market. If your stop price is $55 and the market gaps down, the very next trade might be at $54.50. Your order is triggered at $55, but it executes as a market order near $54.50. You are not guaranteed to get exactly your stop price. Buy-stop orders work in reverse and are placed above the market price to protect a short position from rising prices. This brings us to the stop limit order, a hybrid designed to give an investor more control over the execution price. This order has two prices, the stop price and the limit price. Like a stop order, it is triggered when the stock trades at or through the stop price. However, instead of becoming a market order, it becomes a limit order. For example, you could place a sell-stop limit order with a stop price of $55 and a limit price of $54.90. If the stock price falls to $55, your order activates as a limit order to sell at $54.90 or better. This prevents you from being sold out at a much lower price in a volatile plunge. But it creates a new risk. If the market gaps down from $55 directly to $54.50, your order is triggered but will not execute because the price is already below your limit. You would be stuck in the losing position. The SIE exam loves to test this scenario. To remember where to place these orders relative to the current market price, use the mnemonic SLOBS over BLISS. The letters stand for sell limits and buy stops, which are placed over the market price, and buy limits and sell stops, which are placed below the market price. Thinking through SLOBS over BLISS is a fantastic mental shortcut for solving order placement questions on the exam.